The Fed is coming after your portfolio, and today we need to talk about how you can stop them. We are 3 meetings away from the October 28th Fed meeting, and for the first time in years, markets are pricing in a rate hike at that meeting. Are they going to raise rates? I mean, it doesn't really matter. Just the fear that they will is already impacting markets. I mean, 6 months ago, they were promising rate cuts. Then Kevin Warsh, the new bloke running the Fed, the new Fed chairman, comes in and he spends his first meeting saying no cuts, maybe even a rate hike. The problem is that your entire portfolio was riding on the promise of rate cuts and cheap money, and now it might not be coming back. So if you hold index funds, stocks, have a 401k, bonds, or you've just got cash sitting in the bank, this video is about your money. I'm going to show you what Kevin Warsh actually did, how it impacts your portfolio, and how to prepare. Right, so before we get to the Fed's evil plan, you need to understand one idea. Interest rates. Interest rates set the price of every asset on earth. Warren Buffett describes them as gravity. When rates are near zero, there's no gravity, there's zero gravity, and everything floats. When rates rise, gravity switches back on and everything gets pulled down. I'll give you an example. Say the bank starts paying you 4% guaranteed interest for doing absolutely nothing. Now, you look at a rental flat that costs 500 grand and clears 10 grand after the cost. That's a 2% return, and you have to deal with tenants, you have to deal with repairs, all that kind of stuff. Nobody sane would choose the flat anymore. They just park their money in the bank. And before anyone jumps ahead, yeah, we'll get to whether that 4% is actually a good deal later. Spoiler, it's not really a good deal. It's not as good as it looks, but it doesn't need to be good. It just needs to beat the 2% that you would get with a flat. So the price of the flat has to fall until it competes with a boring bank account. But this flat is the same flat, guys. The price falls anyway because every asset on the planet is competing with the boring alternative. And when the Fed raises interest rates, the boring alternative becomes good enough, let's say. But the thing is, for 15 years, that alternative paid basically nothing. So everything floated up. Stocks, bonds, houses, crypto. Sorry, did I say crypto? I meant crypto. All of it was priced for a world where money was free and would stay free. And whether you realize it or not, your portfolio was built on that one assumption, that every time something breaks, the Fed cuts back to zero and the party restarts. Warsh just squashed that assumption though. Well, at least for now, but we'll talk about if he's legit or if he's full of shit. That rhymes. So let's start with what actually happened. Interest rates are sitting at about 3.63% right now. And for years, every Fed statement carried a little line hinting that cheaper money was on the way, that they would start cutting rates, maybe, something like that. Actually, let me explain what this whole cheaper money thing is. Cheap money is essentially when the Fed prints money and floods the system with it. That is a little simplified version of it, but it's a high-level overview. Now, more money in the system means that asset prices go up, stocks, property, etc. But the Fed has spent years removing money from the system lately. Then every time things got a little shaky, they say, don't worry, cheap money will be back soon. We'll start flooding the system again soon. It's almost like they're dangling a carrot to keep market stability intact, and that carrot often does prop markets up. Also, even though they've removed money from the system, during COVID, they pumped so much money into the system that it's still supporting higher asset prices to this day. So the stock market has been running to all-time highs, property prices are up, and it's all great. I mean, if you're in the market, if you own property, it's great. For years, the market leaned on that line, promising cheap money if the market ever got into trouble. Then Warsh came in and he just binned this whole idea in the first meeting in which he was in charge. And the vote was unanimous. It wasn't just Warsh, it was the whole committee. And now they're openly discussing hikes, with October 28th being the date that the market is circling for these hikes. Now, I want to be clear, this could be a ruse, a scam, an act, but it could also be true because let's face it, inflation is up and it is getting higher. I mean, they did manage to take it down to 2.4% not long ago, but it's back up at 3.5%. But we all know it's actually higher than that, but you know, the numbers are heavily manipulated, allegedly. And the way you combat inflation is by raising interest rates. So there is technically a logical reason to raise them. Meanwhile, the 30-year Treasury yield is around 5.09%. That's the return investors demand to lend money to the US government for 30 years. And the US government needs money because it spends $2 trillion more per year than it earns, which is a lot. So the government borrows by issuing bonds or treasuries, and when confidence is high, yields on those bonds, treasuries, is lower, say 2%. When investors want more compensation for inflation or risk, yields go higher, like they are now at 5%. And if you bought an older bond when yields were 2%, that bond is now worth less in the market because new bonds are offering much better returns, 5%. So why would I buy your 2% yield bond when I can buy a 5% one for the same price? I wouldn't. So you have to lower the price of your bonds. I know this is confusing, but the point is, the longer rates stay high, the more pressure that puts on bond prices and on the people holding them. Now, think about who holds those bonds. pension funds, retirement accounts, target date funds, insurance companies, banks, etc. But you likely own some in your retirement account, which is not great for you. That's bonds. Now let's talk about stocks, because this is where it gets even crazier. Remember the flat I talked about? Why would you buy a flat to rent out and deal with tenants and repairs for 2% per year when you can simply park your money in dollars and get 4 to 5% per year? Every stock competes with a boring alternative, with parking your money in bonds or just in dollars. And the more you pay for a stock relative to what it earns, the more that price depends on cheap money to make it make sense. So how expensive are US stocks right now? They're very expensive. On a long-term valuation measure, the market is more expensive than it was just before the 1929 crash, and the only time it was higher than where we're at right now was at the peak of the dot-com bubble. In other words, stocks are trading at historically extreme levels, which is why a lot of people are very nervous about these prices. And back to bonds and how this all ties together. If yields are around 5%, stocks have to justify themselves against that. So a lot of people right now do not want to put money in the stock market anymore, because bonds just, they're less risk and you get almost the same thing. And look, don't tell me you're fine because you hold index funds and you're diversified. Around 40% of the S&P 500 is now concentrated into the top 10 AI stocks. So if the AI bubble pops, and it looks like it might already be popping, the S&P 500 is not going to have a good day. Holding the S&P 500 is not diversification, it's concentration into AI right now. And like I said, the AI bubble might have already started to pop. Chip stocks are down 20% from their June peak. You can track this by looking at SOX. It's the Philadelphia Semiconductor Index, an index made up of the big players in the semiconductor space. 20% is an official bear market in the most crowded trade on the planet right now. And look, the cracks always show up at the edges first. And the people in the middle keep saying, it's contained, it's contained. But you know what? I actually remember in 2007 when the two Bear Stearns hedge funds collapsed, the ones that started the whole 2008 financial crisis, everyone was saying, don't worry, it's contained. And then it wasn't contained. But look, now let's put the bonds and the stocks together, because this is the bit that should worry you the most. For decades, the standard advice was the 60-40 portfolio split. 60% stocks for growth, 40% bonds for stability. The idea was simple. If stocks fell, bonds would usually rise and cushion the blow. But that only really works when inflation is calm. Once inflation shows up, the central bank has to raise rates, and that can hurt stocks and bonds at the same time, as I've already pointed out. So instead of one side cushioning the other, both sides can be under pressure together. We watched this happen in 2022, actually, the worst year for the classic 60-40 portfolio split in nearly a century. Picture a bloke in his mid-50s who did everything right, maxed out his 401k, sat in target date funds, and got what he thought was a balanced portfolio. Then 2022 happened. His bond allocation got smashed because rates rose fast, and when yields go up, bond prices go down, and his stock allocation didn't rescue him because inflation and higher rates also put pressure on stocks. So instead of one side cushioning the other, both sides got hit by the same inflation shock. And by the way, if inflation is eating into your savings and you want a proper plan for how to manage it and retire by 2036, I have a free guide for you. How to retire by 2036, there's a link to it below. Check it out after you finish watching this video. Also, when you grab it, you get signed up to my free weekly newsletter, which I'm sure you will love. But compared to what might be coming, 2022 was kind of nothing. It was easy. But this is where we get to the important part, because they won't tell you that, because they want your money and they'll do anything to get it. This is common before a collapse. They suck all the money out of retail because they know they'll need it for what's coming. Open YouTube right now, open your bank's research page, turn on financial news, and it's the same message everywhere. Savers are finally winning. Lock in these yields. Best time to be a saver in 15 years. Lend your money out and get paid for it. And look, I understand why that story lands. The average savings account still pays 0.4%. So when someone shows up with 4%, it feels like a gift. So let me check the maths on that gift for you. Treasury bills pay just under 4% right now, and inflation is running at 3.5%. And that's what the official numbers are, which, by the way, are nonsense. We know inflation is higher than that, really. But let's pretend that that number is real. You gain 4% interest, inflation is at 3.5%. So in purchasing power, you end up 0.5% ahead. Then tax comes out, and that 0.5% gets eaten away. So holding treasury bills means you still lose a little bit of money, but it's better than 0%, right? Now, I always use a quote from Charlie Munger in my videos. He used to say, show me the incentive and I'll show you the outcome. So So who benefits from you falling in love with lending your money out, from you lending your money to them? Who has the incentive to convince you to lend your money out to the US government or to private equity or to whoever? Well, the US government collects about $5 trillion in tax and then spends $7 trillion each year. So that's a $2 trillion gap. I talked about it earlier. Every single year, $2 trillion, and someone has to lend that money to them. But their old lenders, other countries, have stopped lending the US money because most countries around the world they don't trust the US anymore. The share of US treasuries that foreign governments hold has dropped from 72% in 2001 to 56% today. So the biggest borrower on earth needs fresh lenders right as the old ones walk away. And all of a sudden, every channel, every broker, and every banknote is telling you that lending money is the opportunity of a generation. Of course it is, but in this equation, you are the sucker if you fall for it. I guess I have to throw in an allegedly here, allegedly. And by the way, we've been exactly here before. Let me tell you about 1994 because almost nobody remembers it, but the people who lived through it, they'll never forget it. I lived through it technically. I was 8 years old. I did forget it. So, some people did forget it if they were too young. Anyway, the point is, through 1993, rates were at 3%, the lowest in a generation, and the same advice about lending your money to the government and to businesses was peddled back then too. Stop sitting in cash, extend out, buy the longer term bonds, pick up the extra yield, blah, blah, blah. It was all the same nonsense. Then in February of 1994, Alan Greenspan started hiking rates. He was the Fed chairman at the time, and he didn't stop. Rates doubled inside of a year, 3 to 6%, and nobody important saw this coming. I mean, nobody. Global bond markets lost around 1.5 trillion that year. 1.5 trillion in 1994 was insane amounts of money. Fortune called it the Great Bond Massacre, and the safe part of everyone's portfolio delivered its worst year in decades. And the poster child for this was Orange County, California, one of the richest counties in America. This story is so funny. Their treasurer, a bloke called Robert Citrin, ran around a $7.5 billion fund. And for years, he was the star of the show, beating every other county's returns. How? He borrowed against the fund to control nearly 20 billion of bets that only paid off if rates stayed low, but they didn't. So everyone cheered while it worked. When Greenspan hiked rates, the fund lost 1.7 billion and Orange County went bankrupt. The biggest municipal bankruptcy in American history at that time, caused by the safe part of his portfolio. Oh, and it also came out later, this is the funny part, that Citrin had been consulting a psychic and a mail order astrologer about interest rates. Billions of dollars of public money, all based on the psychic say so. Absolutely crazy. And to be fair, his forecasts though, they actually were a bit better than most of Wall Street's that year. So who knows? Anyway, that's the whole lesson from 1994. But today is not 1994. And every time something like this happens, there are slight differences. So I'm going to give you the counterpoint to what I'm saying because it's important you understand that too. First, this time around, I don't think Kevin Warsh can start hiking in the same way that Greenspan did back then. The US is in too much debt right now. Hiking aggressively is not an option, but he doesn't need to hike interest rates aggressively. Even just a small hike at this stage would have the same effect, or arguably holding where we are now for an extended period will probably have the same effect. Second, it is plausible that inflation drifts down on its own, that the Iran situation settles, and that oil falls back down and Walsh ends up cutting rates like he promised Trump he would. In that world, the repricing happens slowly and gently, and this video looks stupid a year from now. It's plausible. That could definitely happen. Look, I've been wrong many times in my career. Luckily, you don't have to be right about everything to make money in this game. You just need to be able to recognize when you're wrong and adapt quickly. The point is, don't go sell everything because some random dude on YouTube told you a story about 1994. That's not how it actually works. Okay, so what am I actually doing with my own money? 5 things, and none of them are overly dramatic. I'm going to go through them. First, whatever yield I take it short term. I have a bit of cash sitting around right now because I want to buy assets at cheaper prices. I feel everything's too expensive right now. I don't want to buy right now. I know I said treasury bills, bonds are for suckers, but that's buying them as an investment. This is different. I'm just parking a little bit of cash there while I wait to buy cheaper assets, and just under 4% beats 0% that I would earn if I just chuck it in the bank, right? I know some people on YouTube operate in black and white mindsets, so this is going to sound like a contradiction to what I said earlier, but it isn't. I'm using the system they've built to trap suckers against them, short term. Second, I audited my portfolio. I sold most of my AI and tech stocks at the end of 2025, and I took pretty good profit. Now, a lot of people are going to say, well, AI stocks kept moving up in 2026, but it was marginally higher than where I sold, so it doesn't really matter. Plus, I parked my money elsewhere, and the returns there have been better. After watching chip stocks unwind for 3 straight weeks, I'm even happier that I got out. Look, open up your own portfolio and ask yourself this question. It's a very simple question. Would I buy this today at this price with treasuries paying 4%? If the answer is no, then you have your answer. You shouldn't be holding it. And to be clear, I'm not saying that you should sell and park your money in treasuries at 4%. That's not the point of this exercise. The point is looking at stocks the same way a lot of investors around the world are looking at them. Because a lot of people are asking, would I buy it at this price when I can get 4% risk-free? So if the answer to that is no, it means a lot of people are going to be thinking that exact same thing, and they're going to be getting out of those stocks, which isn't great for the stock. Third, I own boring businesses with pricing power. Consumer staples, utilities, energy. People buy toothpaste and electricity at any interest rate, at any price, and none of those businesses need cheap money to justify their prices because people need those things, they're necessities. There are times in the market where you want to take risk, and there are times where you want to be boring. I personally think, just my opinion, not financial advice, it's time to be a bit boring. The market is overheated right now. I mean, look at SpaceX, look at chip stocks. I feel like boring wins the day these days anyway. Fourth, I've moved my money outside of America. The US is now 55% of the entire world stock market, and it's so overheated compared to the rest of the world. So I sold my S&P exposure this year and bought Poland, of all places. I know, it's crazy, but it's beaten the S&P since I bought it. So the S&P is up about 8%, Poland's up about 20%, and I'm talking about the WIG, the WIG, the Polish index, the main one. And look, it doesn't have to be Poland. Poland has its own problems, and the EU funding is going to end for Poland at the end of this year. So I'm not sure how much longer I'm going to be holding Polish stocks. The overall point here is to consider exposure outside of the US. The US isn't the only stock market in the world. South Korea returned what, like 70% last year? Although, you know, they're in trouble right now. The point is, last year there was a better opportunity out there, Poland or South Korea. This year there's a better opportunity out there. Next year there'll be a better opportunity out there. So don't limit yourself to the US. A lot of people make this mistake. Fifth, consider having a pile of cash for the short term, because if the repricing I've described plays out, the best buying opportunity in a decade comes with it, and cash is what lets you take it. In 1994, the boring T-bill people ended up buying the wreckage. I plan on being one of those boring T-bill people, although like I said, my T-bill positions are super short term. I'm just parking the money there because it's better than having it sit in the bank. So I don't think that the Fed has handed you a gift this month. I think they've done the absolute opposite. I'll see you in the next one.